on when I started my business, like, hey, like if we pool our money together, we can buy this bigger asset, got better negotiating power, maybe on like a per door basis, it's going to be better value, better returns, and buying a bunch of single family homes.
Welcome to Spur Equity's Spur Your Wealth podcast, your ultimate guide to passive income through real estate investing. Join us as we together discover the secrets of building wealth, one passive investment at a time.
From expert insights to inspiring success stories, this podcast will inspire you and empower you to take control of your family's financial future so you can live life on your own terms.
All right, welcome everyone to another episode of Spur Equity's Spur Your Wealth podcast. I am your host today, Budham Singh from Spur Equity. As you guys know, on the Spur Your Wealth podcast, we aim to bring successful investors and experts on the podcast to share their story and their secrets to investing so we can all stand to benefit from their experience. And so on today's episode, we're excited to have Todd Sulzinger. Todd is the founder and CEO of Blue Elm Investments. It's a boutique private equity real estate firm based in San Francisco, California. Following a successful corporate finance career in the Silicon Valley, Todd founded Blue Elm to offer investors a strategic way to diversify their investment portfolio by creating passive investment opportunities through the acquisition of apartments, mobile home parks, and RV parks. So welcome, Todd, to the Spur Your Wealth podcast. Really excited to having you on the show today, and really looking forward to the conversation. You're one of the first folks on the podcast that have some mobile home and an RV park experience. And I know that you have some property pretty close to our home base in San Antonio. So I'd love to learn a little bit about that as well. So before we get started into the conversation, I want to give an opportunity for you, Todd, to really just tell the listeners a little bit about yourself, your background, how you got into real estate, and kind of, your first deal or your first kind of entry into real estate and where you're at today.
Great. Yeah. Thanks so much for having me on your show, Pod. I appreciate it. Like you had mentioned, thanks for that great introduction. I was born and raised in Northern California in San Jose, went to San Jose State University, got a degree in finance, and started working for a variety of technology companies and built my career that way. And, this is a good place to be if you want to kind of like build a good career path working for technology companies. And I had a chance to, through the first company I worked for, live overseas in the UK, helping some offices open up there and building their finance organizations, came back to the US, went through a few IPOs, had some good success, was kind of growing my career, but also found there were certain times where I would be working for a great company and we'd get acquired and they wouldn't need two finance organizations, or I'd work for a great company and they'd be acquired and they'd want you to move to, I worked for this one company, for example, went through an IPO, great company, great team, and they moved their entire finance department down to San Diego. And while that's a great place to live, I didn't want to move my family down to a new place. So while there's like great things about working in Silicon Valley and in this environment, there are some times where there's still kind of that feeling of a lack of control. Again, if a company gets acquired or goes out of business, whatever it might be.
Right.
So kind of, maybe 15 years ago or so, I was, living next to a guy who was this really kind of millionaire next door kind of character who just drove a beat up car, like just disheveled dress. But the more I got to know him, he would just kind of talk more and more about this homes he owned, neighborhood that he was going to go check on, or a strip mall that he owned down the street, or, this kind of little real estate empire he built. And I just kind of got to know him a little bit better and learn more about his story, and wanted to find how I could do that myself. California is a hard place to do that because it's expensive here and it's a very tenant-friendly state. So I, through just a long process of podcasts and conferences and meetups, I ended up buying some single-family homes in Dallas back in 2013.
Wow.
That was kind of really my first foray into actually investing.
Excellent. So you started with single family. A lot of our, go to conferences. I mean, our own story is very similar, right? We get started into single family because that's kind of the reach, right? Like when you're talking about your own money and things like that, those are some of the things that we all think about as our first kind of entry is, let me start at single family. So tell me a little bit about that. So you purchased single family homes. Was it through partnerships or was it your own in Dallas? And then how did the management of all of that go? And I'm assuming they were kind of like regular kind of leases, right? 12-month leases that you had on those properties. Talk to me a little bit about that.
Yeah, so the idea of doing it in the beginning seemed crazy, because when I had moved out of a house before in San Jose and kept as a rental, and just kind of that was always my mindset of that if you're going to own a rental property, you've got to be someplace close to it where you can drive by and touch it and see it. But I took a field trip to Dallas actually with the real estate guys, Robert Helms and Russell Gray from the Real Estate Guys radio show. They
good company.
Had field trips there. Yeah, what's that?
I was like, that's good company, hanging out with Robin Helms. That's awesome.
Yeah, they used to live, both Robert and Russ used to live in the Bay Area, and they used to just do, like 25, 30-person meetups locally that I used to go to. And through them, I met a turnkey provider out there, a guy by the name of David Campbell, who was buying infill lots and building homes for investors, and, drove neighborhoods, met property managers, talked to brokers, and ended up pulling the trigger and buying it was actually at the time, it was a brand new house in a community that was mostly almost like a build to rent before build to rent was even a thing.
Yeah.
And went ahead and bought a few houses. The financing was good, prices were good, rent ratios were good.
Yeah.
And found a decent property manager and it worked.
That's great. So single family. So what was the next kind of asset type that you looked at after that? And that was your own money, right? So that was like right. Right. So just to be clear, so like, the single family homes, that was you, your family, or your wife kind of putting that money down and saying, all right, let's pull the trigger. But there was a system behind it, right? So somebody put together a system where there's property management, there's, all of that kind of, you met with folks that have a system behind kind of managing all that. Okay.
Mm-hmm. Yeah. And it really did, it struck me when I do have one rental property in Sacramento, California. And it struck me one time when I drove by that house one week and, when a tenant's living in your home, you can drive by and see that the house is still there and check on the yard and see how many cars are up front. There's not much you can do. You just drive by, it's not burned down, go on your way. And then the week after I was in Dallas and I drove past some of my properties and I did the same thing. I drove by. There's a car in the parking lot. The house is still standing. And I thought, so it's no different if I have a house 2 hours from where I live or, thousands of miles away. Sure. It's the same if you've got a good property manager looking after things and, doing annual inspections and taking photos and things like that. So it proved to me that, with the right team in place, you can, own properties long distance and still have them be successful.
Right. So the next asset class or asset type after that, so what was your kind of movement away from single family, or not away, but what was the next thing that you did?
Yeah, well, so I was trying to figure out a way kind of also through that process as I was, I joined the Real Estate Guys Syndication Mentoring Club because I really wanted to learn about like how that process works, right? Because, I had a passion for investing in real estate. I was talking to other people, like colleagues that I worked with about investing in real estate, and they'd have some of those hesitations about, where would I buy? California is expensive. I don't have the time. So kind of learning about this idea of like investing as a group made sense to me. So kind of went down another education path about finding, could I do this? Do I want to do this? What's the right legal structure to put in place? And decided I wanted to start a real estate syndication business. And through that process, I was actually going to partner with a guy that I was working with at the time because we were both interested in getting into the mobile home park space, and ended up putting together a syndication to buy a couple mobile home parks in Georgia in 2019.
Excellent. So, a lot of our investors and listeners that are going to be on this, they're familiar with multifamily, right? Mm-hmm. So they understand the model, or we're kind of communicating the model of like value add and like, different ways that you can increase NOI but mobile home parks, right? So mobile home parks and RV parks and Talk to us a little bit about that business model and the business plan behind, acquiring and, the due diligence behind it and kind of what you look for in a mobile home park to be able to say, okay, I can take it from here to here. And what does that business plan look like? Tell us a little bit about some of the things that are different, right, in mobile home parks and looking at value add or increasing NOI from an investment standpoint.
Sure. I mean, it is one thing. It's a multifamily asset, so in some ways you think, oh, they should be the same, right? It's like people live in a mobile home. In a mobile home park, you can either have a situation where the resident owns their house and you're renting out the lot to them, or the park could own the house and rent it out like you would a single family home or an apartment building. So in some ways you think they should be very similar, but they are run differently. They're managed differently depending on the market. The tenant base can be different at their multifamily. But I was interested in the space because there's a huge need for affordable housing across the country. The mobile home park, when I bought my parks, they were starting to get more popular, but they were still kind of a niche investment. And there was less competition because people are just less familiar with them. And it's not common to be able to find maybe a larger multifamily property manager who also manages mobile home parks. That was one of the challenges that also keeps people from potentially investing. One of the good things about them is that oftentimes they're run by like older mom and pop type operators that may own the park free and clear and just haven't kept up with rents over time, maybe haven't kept up with maintenance in the property. So that's sometimes where the value add component comes into play. For example, the parks that I bought in Georgia, the person we bought the park from only accepted cash. So you can imagine, so he drives to the park 2 or 3 times a week to collect cash from his tenants.
Yeah.
Probably wasn't reporting all the cash that he was collecting, but that was his deal. So because of that, rents were below market. There was some deferred maintenance that we had to deal with because he was accepting cash. He didn't really have a rent roll. He just had a spiral notebook with a list of tenants. No tax returns, bank accounts didn't match. So it wouldn't be something that would be easily financeable in a maybe comparably sized, professionally run apartment building. So that can give opportunity when you can get something for potentially a better price, when you can talk to a seller and say, hey, you just don't have the proper records.
I can't take your spiral notebook to the lender, right?
Yes, exactly right. So that in that situation, we were able to actually get seller financing on the park. Yeah, which is something probably more common in mobile home parks than you might find in apartment buildings. Okay. But it does take then some extra due diligence to kind of like walk the park. If he says that it's 80% occupied as you're going through the park in the morning, afternoon, in the evening, or on the weekends, through due diligence, just to see, are there actual cars in in front of the homes, to verify those. And then you've got to put in that cushion just to make sure if they're, not paying or occupancy is not as high, that you'll still be okay. But I would think from a management standpoint, sometimes they're often less professionally run than an apartment, which can give better opportunity when you're buying.
Yeah, so I mean, we've actually Rav and I have visited, and we actually put some offers down on some mobile home parks in the past, and a few things that we found interesting was depending on the market, right? Depending on the market, there was a lot of effort into kind of adding facilities or adding specific things that will attract, right, folks. Like, for example, a laundry facility on site, or some, even showers. I think they had in one place. They also, they were looking to do. There was like a little snack stand. They were putting playgrounds. Like, they were trying to make it a nice community, right? Not just, hey, you're parking your RV here, your mobile home here, but they're creating this sense of community. And so there's a lot of effort around that. And so the ones that you've purchased, right? So talk to me a little bit about kind of what you did from acquiring the property. What was the business plan in adding, potential services or potential, because I know like Wi-Fi on the grounds or something like that. I know that one of the sellers that we were looking at, he was actually putting in some high-speed Wi-Fi on the whole ground, or something that everybody can take advantage of. So talk to me a little bit about some of the things that you put in place in your business plan to, improve those facilities so that you can, demand more rent, as leases turn and really increase that value.
Yeah. Well, in the mobile home parks that I've purchased, I had purchased parks in Georgia and Tennessee, and have since sold those parks, and I still have one in Arkansas. And those are very much like affordable housing type properties. So, no amenities, no pool, and that's kind of in the park in the market in terms of tenant expectation. It's basically just like a clean, safe, place to,
And so you own the homes there.
We own most of the homes.
Okay.
Yes, like in this park in Arkansas, it's 55 spaces. We own 49 of the homes, and we've got six residents that own their own home that pay lot rent. So there's not really that expectation for kind of fancy amenities. It's more like a Class C type environment.
Sure.
The RV park that I have in Bandera that you'd mentioned just outside of San Antonio, that does have Wi-Fi. That's super important for people, kind of like a free basic Wi-Fi service that we offer. If somebody wants to upgrade to a faster speed, they can do that. That one is mostly monthly rentals where people stay there for months at a time, and does have a daily, weekly component. And one of the things that we're going to be adding is a bath and shower house, because it has a laundry facility. Doesn't have bath shower house, but that's really a requirement if you want to attract daily, weekly vacation guests.
No, that makes sense. That makes sense. So, I mean, between the two types of assets, right, the RV park, where I assume you're just providing the space and like electric and water hookups, right? Is that right?
Yeah, that's correct. Yeah, the park that we purchased, it's 57 spaces currently, and we're going to be able to add around 20 to 25 more spaces kind of between where the park sits now and a river behind it. And as we expand out closer to the river, those are going to be more daily, weekly sites. So that's why we're going to be adding a bathhouse. We have a plan to purchase some Conestoga wagons. So kind of these like old, it's an old like Conestoga wagon, but they're for glamping essentially. So to offer those to guests staying at the park, if you've got an RV, we'll have new RV sites for people. But if somebody wants to do more of a kind of a glamping experience type situation, we're going to put those on Airbnb, and they're beautiful inside. Just comfortable beds. They've got a bunk bed, or really nice. So we think that'll really attract guests.
That's really great. That's great. So what between the two, which what are you partial to, or and then secondly, I guess from a investment standpoint. Because the other thing is, when we look at purchasing some of these properties, like cost segregation studies and depreciation and things like that. So I would assume that they're a little bit different, right, in terms of what kind of depreciation you can get from lots versus, the homes that you purchase on top of them. So can you speak to that a little bit?
Yeah, it's like which one am I partial to? Oh gosh, they've all. I think every asset class has its pros and cons. Because in addition to the mobile home parks and RV parks, I've invested personally in mortgage notes that are totally passive. I've partnered up with people purchasing multifamily apartments. So all very different, pros and cons. I can't really say I've got a favorite at this point. Tax standpoint, the cost segregation's been fantastic. I think we've had really good luck with the mobile home parks where we've been typically the amount that you can segregate to take advantage of bonus depreciation in mobile home parks is greater than apartments. And it's really amazing the cost segregation work they do, and they can kind of go into a mobile home park and essentially value what it would take to build the park from scratch. So, how much it would take to run sewer, run electrical all throughout the park. And that value adds up pretty quickly. So I know in my parks in Georgia and Tennessee, I don't know what the exact percentages were, but it was like north of 75% that we were able to, or the purchase price we were able to take as the first year depreciation with the bonus depreciation rules.
That's great. That's wonderful. Let's talk about kind of what are you finding this year? Are you still looking at, in 2023, are you still looking for these types of assets. I know the one in Bandera you actually purchased in end of 2022. So in
Yes, correct.
2023, are you still pretty bullish on, finding these types of opportunities? And if so, which markets are you looking at, and are you finding kind of the prices are still remaining, kind of the same, or are they being impacted just from a lender, because the lender and interest rates? You mentioned that seller financing is pretty common in the mobile home park. So have you experienced any sort of impact over the last, year or so?
Well, my business has transitioned a little bit since I've purchased those properties. You mentioned the RV park. Yeah, it was that situation was kind of a one-off. I had a good friend of mine was involved in a partnership that was connected to this park in Bandera, and brought me into the project. So I wasn't necessarily looking to get into that asset class, but I was close to it because of my mobile home park experience. And this particular location, the fact that the park was relatively new, it had only been built about 2 years prior, it had the expansion capability, made me really intrigued. And there'd been such great growth in the RV business in general, kind of, as we went into the pandemic and people's travel patterns started to change.
You, as yourself, you can only do so many deals, right? You only have a limited amount of time to acquire and operate and do all of the things that we need to do. And so it very quickly leads yourself to, one, relying on partnerships, relying on people and their expertise and leveraging that to kind of grow, right? So they grow and you grow. And then finding what your strengths are, right? Finding what your strengths are, whether you're a property manager or an asset manager, acquisitions person, or, somebody who can really bring the capital stack. And it also has to deal with, whether you're working full time or not, right? In addition to all of this investment, so all of those things kind of play into it. Up until recently, I was right, and so the fund to fund model I think works really, really well, especially if you've throughout the course of your experience found those operators or continue to find operators that are like really, really skilled in what they do, and then you're like, great, I want to do another deal with this person because the way they're managing this particular asset, it's excellent, exactly what my investors need. So let's push them, or let's partner up and say, hey, we can bring the capital, we'll sign on the loan, whatever it is. Let's go find more opportunities together. I think that is a natural course of action, right, for folks like us. I think that's great.
Yeah, yes, for sure. And I think in the same way that when I would talk to my investors early on when I started my business, like, hey, if we pool our money together, we can buy this bigger asset, got better negotiating power, maybe on like a per door basis, it's going to be better value, better returns than buying a bunch of single family homes. Similarly, in this fund to funds model, you can say, hey, if you could absolutely go to this sponsor directly and invest $50,000, but if we can bring $1 million or $2 million together, negotiate better terms as a group, then we can pass that through and share in all of that. And that's been positively received by my investors, because they're thinking like, I would have found these sponsors myself or these markets. So that's been good to be able to bring those kind of opportunities to them.
So for the fund to funds model, do you launch your fund with that project in mind, or do you raise funds ahead of time, thinking that, hey, we're going to go after, this criteria of investment project, it's going to be an apartment, built a complex, et cetera, and you raise funds ahead of time and say, okay, we have $1 million to kind of inject into a project, and then you look for an operator, or is it vice versa? How do you normally?
Yeah, I've been doing it project by project. So kind of like finding the operator, finding the deal, and creating the fund specific to that project.
Excellent. No, that's great.
Yeah.
That's great.
Have you done the same?
Yeah, we've done a mix of. So initially, that's how we've done it, and you're absolutely right. Like the negotiation power that you have when you can pull your money together, you actually get better terms. We've actually gone to sponsors and say, before they even put their PPM together, and say, hey, create a separate class of investor for us, right? So if they have the retail class, we'll say, hey, just very easily, just create a second class that has, a better profit share, because we're bringing a larger check to the table. And so we get to benefit, our investors get to benefit. So to your point, they can go to the sponsor directly, but they would get a lower lower profit share because they're not coming in through our specific class. So like it works out to everybody's benefit. It's a win-win. And that's why I love this space, right? It's a win for the senior sponsor because they have less to lift, right? We're doing all the lifting for them. It's a win for us because we're, providing that opportunity. It's a win for our investors because they're getting a better return through us versus going directly on the retail side. So it works out for everybody. And so, I think it definitely makes nice collaboration, right? If you have those relationships. So that's how we started. I think going forward, we are going to look at, because one of the things is, once we have deal flow, that's when if you have capital ready and investors are ready to invest and you have good amount of deal flow, you can be able to do that pretty regularly. And what we're finding this year is deal flow has actually slowed down, right? There's less deals out there, but investor sentiment also has, kind of mixed feelings, right? Like, let me stay to the sidelines or whatever. And so we're starting to balance that. But I think what's going to happen is investors are going to be ready because they've been 3 months, 6 months of capital just sitting doing nothing in a bank account. So they're hungry for deals, but they want to be, they're a little careful. But at the same time, I think if we have a commitment that, hey, this is the type of project that we're going to go after, I think we're gonna have commitment for a fund where we have money ready to call when we find an opportunity, because that we can then turn around really quickly. And we've done we've done a dozen plus deals, right? 16 plus deals. So we have a lot of repeat investors. So I think they understand, they have that confidence. And so, if we say, hey, there's a deal that's worth going forward with, they'll go forward with it. And so if we have that commitment and we find the right deal with that criteria, I think it's a much easier path, right, to getting all of that done. And again, from a negotiation standpoint, when you tell a senior sponsor or like an institutional sponsor that, hey, I got 2 million waiting, right? I got 2 million ready. It's a much different conversation in terms of negotiating the terms of that profit share versus I think I can raise 2 million, right?
Yes. Exactly. Yeah. I haven't gone down that path yet. I think at least the investors that I've in my discussions with investors, they tend to be able to know what they're investing in ahead of time. They get excited. Absolutely. Oh wow, like an RV park. I have an RV. I totally get that space. Or I heard great things about Dallas, so they get that. But there's definite value in that because when you're working with sponsors, it's kind of an unknown in terms of how much any particular deal in a particular market is going to resonate with your investors at that point in time.
Right.
Yeah.
The other thing that we've been doing, because of the deal flow being kind of slow, is reaching back out to our kind of top tier list of investors and saying, what gets you excited? What do you want to, what do you want to see? And so then we can start targeting those diverse assets, right? And so one of the things that we launched this year was a fund for industrial assets. So, all the stuff that they've been hearing on multifamily and, some of the scary stories, with some bad operators and stuff. So we're like, all right, let's focus on industrial. It's a lower risk asset. It's fully predictable. It's fully triple net, right? So expenses, so we're not going to be hit by inflation. So utilities, tax, insurance, none of that even applies to us. So we're really just looking at rent growth. And so fully triple net opportunities, lower risk. That seemed to resonate with some of our investors. So we launched that fund just to kind of address this concern of let's hold off a little bit on multifamily for a bit until we see what the interest rates are doing, and then we'll circle back. So, but we still wanted to provide something. So I think that's where folks like you are in a good position, right? And because again, a fund to fund model, right? If you're out there vetting institutional and large sponsors and finding the best ones that are doing these things, and the returns might be a little lower than what we experienced the last couple of years, but that's but if the risk is lower, that the risk tolerance kind of matches the returns. So that's kind of what we've been able to do as well.
I agree. I think it's a great thing just to be able to, again, offer that diversity to investors, where I know there's sometimes investors say like how do you find these people? Like how do you vet them? And it's, things like going to conferences and having conversations, and that kind of then clicks in their head like, oh yeah, like I don't have to do that, right? I've got my day job, and
right.
They can then they're not going to just spend whatever, fly to Dallas or Florida or wherever it might be to attend a conference and hang out and meet people face to face. But that's what I can do for them.
Yeah, absolutely. So we've been talking to investors about, again, just making it real about the stuff that we do as sponsors, right? And I've been we've been communicating, and as well as anybody that we look at probably a dozen plus deals before we even say, hey, maybe we move forward with this one, right? And even that's like a maybe. And so, there's a lot of work that goes into that, and the due diligence, right? How many properties we do due diligence on, and then ultimately say no and move on to the next one. So talk to us a little bit about two things. One is, risk, right? Risk management, and kind of looking at these properties, and again, I'm gonna keep coming back to, I know you do more than just RV parks and mobile home parks, but I'm interested in stories, right? That like due diligence, like any specific stories come to mind, red flags or deal breakers that you've encountered when doing due diligence on properties. It doesn't have to be mobile home parks, but just to shed some light into some of the things that we encounter, right, when we're doing due diligence on these properties before we, pull the trigger on moving forward with an acquisition.
Yes. I mean, I think about before I bought my first mobile home parks. I mean, I looked at 100 plus different deals, and sometimes it's just kind of the obvious ones from the get-go about, the broker P&Ls don't match reality, right? Whether it's just something they made up or something they got from the seller, that are just so far from the truth. And when I was doing some work on the mobile home park consulting side, I'd have potential buyers come to me and say, oh my gosh, I saw this mobile home park somewhere and it's listed as a 12 cap. And it's like, okay, let's take a look at things. And eventually it's not really the case. It's like rents aren't what they say they're going to be. There's no property management or no maintenance, or there's no landscaping. How is that? Oh, it's because the person who owns it actually does all that work.
Yeah.
But then when you put that into the P&L, if you're going to run it as an independent, even locally, but definitely remotely, you have to put those expenses in there.
Yeah.
So, that would often, if a deal looked like it was pretty good, that would often be something that would just be not necessarily a red flag, but something that was obviously not going to make the deal work. In the mobile home park world, there's often, sometimes they're in more rural locations where they won't be hooked up to city utilities. So if they're not hooked up to city sewer, they might have septic tanks. If they're connected to the city sewer, they still might have a lift station in the park to get the sewer out to the street. So that's something you might find. Sometimes they won't be hooked up to city water, and they might have a well on site. And sometimes that can be fine if the well's in good condition, the pump's in good condition, the water's been tested, but it does add another kind of an extra layer of due diligence or something to put into the into the projections and into the plan, where you say if you might need to replace the lift station pump, or you might need to do some of the work to replace sewer pipes, or have a waste treatment facility maintained. So sometimes it's kind of digging through the information, what's kind of presented to you when you buy it, and just kind of going through that long checklist and of those kind of things to look at. And sometimes it is a deal breaker where you might talk to a seller and say, hey, the price is good if this water treatment system or the well was running in great shape, the price would be good. But we're going to have to spend a couple $100,000 a few years from now on this potentially, and sometimes you can't come to an agreement with a seller, and that can have deals fall apart as well.
Yeah, absolutely. I'm reminded of, again, we go through so many deals, and I mentioned to you earlier that before our conversation here, we're talking about deals in San Antonio, And, everything that we found, I live in San Antonio. I have deals in Houston and Dallas and Phoenix and other places in Arizona, North Carolina, South Carolina, but I don't have anything in San Antonio because everything in San Antonio right now is, one, it's overpriced. And so when we do those numbers, it just doesn't come out. Like there's no cash flow. And so when we look at you to your point, when you look at the seller's pro forma and their P&Ls, very simple example, we were looking at this smaller property a buddy of mine was looking at, and everything on paper looked great, right? But then you dig in and you're like, wait a minute, their property tax hasn't changed from their T12 to their pro forma. Or their insurance hasn't changed from their T12 to their pro forma. Like when we purchase this property, those numbers are going to change, right? Like those numbers are going to change. And so when you plug those new numbers in, it's like, wait a minute, cash flow just went down to negative. So, the devil's in the details, like you're saying. Like, if you don't know how to run a property and you can't sift through some of the P&Ls and say, wait, they haven't accounted for X expense or Y expense, or this has to change, or, and you have extensive knowledge on the mobile home side that, hey, these parks, they have regular maintenance that is just not accounted for in the P&Ls that you're looking at, and you got to factor those in. It's going to be a completely different story, right? And so your projections are going to be off and wrong. And so a lot of that, comes through just digging into the details, really, with yourself and with some experts like the GC contractors that are going to do some of the deferred maintenance work and things like that, and what that's going to cost, because you can't take everything at face value, right, from the seller. And so,
Yeah, and that's kind of very similar. I was doing that same analysis when I was buying directly, but then similarly working with sponsors, creating a fund. It's looking at their underwriting model and really understanding what those assumptions are. And I have walked away from deals that I like the sponsor, good market, but I just didn't feel comfortable just with some of the projections and some of the assumptions. So there's kind of this level of review if I'm going to invest passively, because I invest passively in syndications as well. So that's like a level of analysis. But then if I'm actually going to bring it to my investors, that's like a whole level different.
The whole level of scrutiny different. Yeah, absolutely.
Exactly.
Absolutely.
So there's been certain times where I just didn't feel comfortable with rent growth assumptions or exit cap rates, or just the way the the way they thought they were how quickly they were going to renovate units. And again, I trust the operator, tons of success, but it just certain particular deals don't feel good enough to me to be able to bring to my investors is something I'm excited about.
Yeah. There are certain key assumptions at a high level, like you're saying. If you're a passive investor, we invest passively as well. There are certain key measures that you have to look at. There's certain key indicators in their underwriting that you got to look at, like the reversion cap rates and rent growth, expense growth, all that stuff. So if they're projecting even just 1% higher than what you typically know, conservatively, that makes sense. That changes the projections considerably. Like they're painting a much rosier picture than reality is in front of us. So yeah, definitely need to look at those key metrics in underwriting just to understand what the assumptions are going forward, and whether reality is baked into there for that specific submarket, because what would work in Dallas doesn't work in Austin, doesn't work in San Antonio or Phoenix, etc. So knowing that particular market is really important as well.
Absolutely.
So a couple more things. I know we're this has been a great conversation. I know we're going on time here, but I want to understand from you a couple things. One, what does the future look like for you, and what gets you excited about 2023 and beyond, from an investment standpoint? Talk a little bit about that for yourself.
Right now I'm in conversations with several different operators that have really interesting projects. Actually in California, again, I'm not sure if this will come together, but in talking to some people that are doing some infill development here in Northern California, I typically don't try to look for investments here because it's expensive and it's there's rent controls, very tenant-friendly state, but it's very common here in Northern California, in Silicon Valley, where you might have an acre property that may have had a commercial building on it, or single family home and somebody buys it, tears it down, and puts up 30 to 50 townhomes. You just see it all over the place here. And so I'm talking to some people that have done that quite often in the Bay Area to potentially work with them on some of their projects. So I think that's it. So I think there's a lot of good people out there, experienced people that are in good markets. In a time right now that there's a lot of distress. There's some kind of distressed sellers. I mean, I know you're very familiar with it, but maybe for some of your listeners who aren't, there's a lot of people that bought properties over the last 3 or 4 years with floating rate debt that they can't refinance. Their interest rates are too high. They haven't brought up net operating income enough to be able to refinance, and they're in a position where they're either going to lose the property or they're just going to sell it at a discount. And we're seeing that over and over again where I know some of my investors say, like, oh, when's the bottom? When's the right time to buy? Is it going to be later this year, early 2024? And it's always hard to time the bottom, but we're definitely seeing now that in the right markets, if you can have the relationships and can find the right opportunities, there's great deals out there right now. So that's one thing I'm trying to talk to my investors who are skittish right now is to say, like, don't be the people that a year from now say, oh man, we should have invested last summer, because that's
always the case, isn't it? I mean, people talk about 2008, right, and the collapse and everybody kind of sitting to the sidelines. That was the year after that, the most self-made millionaires that created. It was that event. And so everybody that stayed on the sideline just kind of status quo, but the people that took the risks during that time actually made out so well. And so same thing, I try to, we try to remind ourselves, we try to remind our investors that with any, kind of dip, right? Any kind of, slowdown, there's always opportunity. So when somebody asks when is the right time to buy real estate, the answer is always now, right? It's always the right time to buy real estate. You just have to find and sift through the opportunities, just like we always have been. There's always opportunity. And even now, because the deal flow is actually decreased, it's probably easier to sift through, right? Because there's less deals out there. There's, and so you can find that gem, that hey, this is going to ride out, this whatever challenges we're going to face. And if you underwrite it correctly, if you get the right debt, we did a project just a little while ago. We said, hey, fixed rate debt, let's just do it. Protect ourselves, predictability. We'll refinance on the other side whenever we have an opportunity. But right now, what we need is stability and predictability, and that's it. And that's what we did. And so, there's always opportunity. So I think, was it Warren Buffett? When people are scared, get greedy. When people are greedy, get scared. So same concept, right? People are scared right now. So keep your eyes open, right?
Yeah. And I just continue to read just article after article, study after study, just talking about, household formation over the next, 10, 15, 20 years. And the lack of housing, right? And it's being compounded now because interest rates have increased. There's less building, less apartment building, less new home building. And there's just going to be a need for, more apartments, more houses to rent, more apartments to rent over the next 15, 20 years. So I think being a part of that is the right place to be.
Absolutely. Well, great. So any final thoughts, any final, piece of advice for somebody who's starting out in real estate? Like, I'd love to have you share your final thoughts with us, as well as if investors want to get in touch with you, how do they get in touch with you? What's your best method of getting a hold of you, Todd?
Sure. In terms of advice, I think my advice would be to take action. I think you can study and you can read, but if you're going to buy your first property yourself, it's like, do the analysis, make sure you're not taking on too much risk, but actually take action. There's nothing like actually the experience you get from actually, owning, like in my case, the first single family homes I bought in Dallas. There was nothing like that. Going through the loan process, dealing with a property manager, kind of, reviewing tenant applications, that process is invaluable. So, and then similarly on, if you're going to make a passive investment, talk to as many people as you can, listen to podcasts, read books, educate yourself. But then, actually one of these days you're going to have to pull the trigger. And that's when you kind of start to have that experience of, okay, this is the way the process works. This is how distributions come. This is the kind of reporting I get. So I would say take action is a big thing for me.
Excellent. Great. That resonates well with what Rav and I believe at Spur Equity also. So, we always talk about that, about taking action. Definitely educating yourself. Don't go blind. Surround yourself with people. There's so many more resources out there today than there were 10 years ago. So educate yourself. Surround yourself with people that know the market that you're interested in. But definitely, it's going to be up to you to take action. So that's excellent advice, Todd. So how does somebody get in touch with you, Todd? How do we connect with you?
Sure. My company is Blue Elm Investments. Actually just rebranded and relaunched my new website. So it's www.blueelm, like blue like the color, elm like the tree, investments.com. You can reach me at Todd, Todd, at blueelminvestments.com. The new website's got our portfolio, other podcast appearances, blog posts, a lot of educational information on there, as well as you can download an ebook that I was part of called Success Habits of Super Achievers. So I'd encourage everybody to go in there and check that out and download that ebook. And I'd love to talk to you. I love talking about real estate investing, different asset classes. I run a meetup here locally in Silicon Valley. So if anybody's local that wants to come check out and meet in person, they're welcome to find me there.
Excellent. Thank you, Todd. And Todd, check out his website, blueelm.com. And I saw there's a lot of podcasts, interviews that you've been on. So it's on the website. And so I want to thank you for sharing your time with us today on Spur Your Wealth podcast. I really enjoyed having you here. This was excellent, truly inspiring. And I wish you ongoing success with everything that you're looking to do.
Likewise. Thanks, Bram.
And then for listeners, thank you for tuning in to this episode of Spur Your Wealth podcast. Again, I am your host, Budham Singh from Spur Equity. Remember, your journey to financial freedom begins with knowledge and action, where knowledge is power, but action is a superpower. So until next time, happy investing.
Thank you for joining us on this episode of Spur Your Wealth podcast. We hope you enjoyed the valuable insights and inspiration. Don't forget to subscribe to our podcast and stay updated on future episodes filled with actionable tips and strategies.
If you want more information about our investment projects, visit us at spurequity.com. If you have an inspiring story to share and would like to be a guest on our podcast, email us at podcast@spurequity.com. Until next time, happy investing.